Our next guest, he's chief economist for HSBC, Stephen King, joining us in the studio now. Good to see you, Stephen.
Hi.
Thanks so much for coming in. So, will Portugal be the last Eurozone nation to be bailed out?
That's a very difficult one because, of course, people first of all said that Greece would be the last, then Ireland will be the last, and then Portugal will be the last. The problem really is that lots and lots of countries in the Eurozone still have these very high levels of debt. The cost of servicing the debt is extremely high. The amount of austerity that may be required is still very, very great. You're never quite sure as to whether the politicians can deliver the amount of austerity that's required without making a mess of their banking system. So I think you can never say never. There is still a risk of other countries having difficulties in the future.
Speaking of those other countries, does this risk drawing attention to Spain's indebted banks and regions?
Well, funnily enough, at the moment, the Portuguese story has actually taken the spotlight off Spain because people are saying, well, actually, Portugal's got a problem and Spain hasn't. I think it's fair to say that for a lot of investors, there's still nervousness about whether the Spanish banking system is fully healthy. And if it's not fully healthy, you've got the problem not so much that it somehow fails, but rather there's a lack of trust in the banking system. And one thing that's really important to build at the moment across the whole of the Eurozone is a return to trust in the financial markets, because if the trust isn't there, it's much more difficult in those circumstances for governments to borrow quite so cheaply.
How do you get that trust back?
Well, part of it is transparency. It's trying to reveal to the investors that actually the banking systems are perfectly healthy. The question is, are you able to make that revelation in quite the way that the investors are looking for? Can you ever satisfy their uncertainties? That's very, very tricky. And of course, the way ultimately you might satisfy it is to have a major change in the constitution of the Eurozone, move towards some kind of common fiscal policy. Therefore, you widen the tax base away from individual countries towards the European Union as a whole. And therefore, you're not quite so worried that the tax base of an individual country is not big enough to cope with the banking system in that country.
Listening to Jean-Claude Trichet today, did you get a clearer steer on the size and pace of any further tightening? We would have been surprised if rates hadn't gone up today.
Absolutely.
But beyond today, is it going to get aggressive?
Well, I think that at the moment our forecasts are that we're going to have a total of 3 increases during the course of this year. We haven't changed that as a consequence of what's happened today. So in that sense, everything's going according to plan. The uncertainties relate partly to the currency. Bear in mind that the Federal Reserve is not particularly interested in raising interest rates currently. So if the ECB pushes ahead on its own, the danger is the euro gets too strong. That creates howls of protest from exporters across Europe. And the other uncertainty, of course, is what happens in the periphery with these fiscal banking difficulties.
Yeah. You mentioned the Federal Reserve there. We seem to have 2 completely different, divergent views on this. Trichet versus Bernanke, one saying inflation is a long-term problem, the other says that it's going to be a short-term problem. Who's right?
Well, part of the issue is whether your monetary policies are responsible for commodity inflation elsewhere in the world. The ECB is now saying, well, maybe our policies of very low interest rates have contributed to rising oil prices, food prices, commodity prices in general. The Federal Reserve is denying that relationship. Actually, I think the ECB has a point. The fact of the matter is that with these very low interest rates in the Western world, it undoubtedly, in my view, has contributed to higher commodity prices. On the other hand, if you raise interest rates when the emerging nations are still growing incredibly quickly, and you can't really control the commodity prices, the only way you're going to bring inflation down is driving your domestic economy into the ground. And that is the danger that we have with the ECB currently. They raise interest rates and then discover that actually the European economy is nowhere near as robust as they'd like it to be. Worry about another recession.
Well, Stephen King, thanks very much. We're going to get back to you in about 2 minutes' time. Thanks so much for sticking around. Sure. Stephen Green. And Stephen, before we get to that, just a quick one on this latest earthquake in Japan. Just talking to Director General of the WTO, Pascal Lamy, a little bit earlier, and he said, well, they had factored Japan, that the last quake less than a month ago now, into their latest report, and they said, well, actually, the economy is strong enough to withstand this shock.
Well, if there's any good news at all that comes from the last earthquake, it's the fact that the part of Japan that was affected accounts for about 4% of Japanese GDP, whereas Tokyo, for example, accounts for about 18% of Japanese GDP. So the fact that the major urban centres were not affected has actually reduced the economic and financial impact of this terrible tragedy over the course of the last few weeks. So in that sense, things are not quite as bad as they might otherwise have been. But it doesn't alter, of course, the fact that the humanitarian story is terrible.
It's awful, and I guess the immediate impact for the region is going to be yet more uncertainty, more nervousness.
Yeah, more uncertainty, and also concerns about global production platforms, for example. We've learned over the last few weeks that other countries, other factories are dependent on components that are sourced from Japan. If that sourcing dries up, there's a tremendous uncertainty about what happens with production in other parts of the world.
Now, in this latest report, when it it comes to emerging markets, you're saying inflation, a serious threat to growth?
Well, inflation's been picking up very rapidly, and of course part of the reason for this is that growth has been turbocharged over the last couple of years, whereas the West has been struggling to recover. The emerging nations have just shrugged off this crisis and grown incredibly quickly, and one of the consequences of their growth has been that commodity prices in general have been rising very, very rapidly. Now, the big question at the moment for these emerging nations is what kind of policy tightening can they deliver? Have they done enough in terms of interest rates and currency appreciation? Perhaps not. Other alternative ways of trying to deal with their inflationary problems. What we're beginning to see in the emerging world is almost a mirror image of the quantitative easing in the Western world. It's what we've called at HSBC quantitative tightening. In other words, you have to raise reserve ratios, you change collateral requirements for loans, you have imposed capital controls, all these things designed to try to limit the quantity of credit in these economies.
And we've seen that in China, haven't we? Not only are they raising rates, but also increasing bank reserve ratios, but inflation is still high.
It takes a while for these things to work, of course, and one sign that the Chinese would point to almost certainly is that looking back a year or so, money supply growth in China was running about 30%. It's now 15%. You can't really explain that through interest rate increases alone, because although rates have gone up, they're still very, very low by the standards of China. So what's really happened is that the rise in reserve ratios has cut back on the ability of banks to lend. It's that cutback on lending, which may eventually point to lower inflation. As with all central banks, the difficulty with the Chinese is that they tighten policy, but the effects feed through to inflation with a significant lag.
It is a significant lag, isn't it? Because food prices are still high, property prices, well, they're sky high, aren't they? Some would say it's perhaps even a bubble.
Yes, and lots of people have said that, although interestingly, of course, given the degree of urbanization that's taking place in China, one might say, well, it's not surprising that property prices continuously rise, because it's partly a reflection of the fact that incomes themselves are rising continuously all the time. If you've got 9–10% growth a year, then in that circumstance, it's not so difficult to explain why property prices might be going up. But I think one critical thing with the emerging nations collectively is that although most of them say, well, we've been given an external shock as a consequence of rising oil prices and food prices, collectively one might say that actually they are directly responsible for the increases in commodity prices, because it's their growth, their loose monetary conditions that are leading to these higher commodity prices. One test of whether QT works, quantitative tightening works, is whether commodity prices themselves fall later in the year.
Yeah, because of course a lot of these emerging nations would say, hey, it's quantitative easing and printing money in the West that caused all this.
Absolutely right. So the reason why they're pursuing this kind of QT policy is precisely because it's the mirror image of QE. It's an attempt to try to limit the quantity of credit flooding around the emerging world.
But so much of this will depend on what you believe is causing these price pressures, this rise in inflation, whether it's external or whether it is because of a loose monetary policy in the emerging nations for a long time.
Part of the problem here is the connections between different parts of the world. The reason why we've had so much QE in the Western world is because there are very high levels of debt. Companies, businesses, households, governments are deleveraging all the time, so therefore the effectiveness of monetary policy is rather low. But because there are connections through the capital markets between the developed world and the emerging world hasn't got particularly high debt, all what's really happened is that the loosening of policy by the Federal Reserve has created very, very powerful economic conditions in the emerging world. That's what you've got to control. That either comes through higher Federal Reserve interest rates, or instead it comes through quantitative tightening within the emerging markets themselves.
So inflation is rising, but it's not yet entrenched.
It's not disastrous as yet, but there's clearly incentive for the emerging nations to control inflation, because as inflation rises in the emerging world, it leads to very big increases in income inequality, and that's particularly socially very damaging.
Do you expect economies like China to quicken the pace of monetary tightening as the year goes on?
They've done quite a lot already. So I think the question now is when we will see the effects beginning to come through. We're seeing it already in terms of money supply. Will it come through in terms of commodity prices? Inflation? I think it probably will second half of the year, but we'll have to wait and see.
And this divergence that we're seeing right now globally, you've got China, the ECB, other central banks tightening, meanwhile the BOJ and the Fed lagging behind. What is going to be the ultimate global financial effect?
Well, part of the issue here is that when you think about the tightening, the ECB is raising rates because it's worried about headline inflation, but it doesn't really have any control over the commodity prices that are contributing to headline inflation. What the US is waiting for, and what the UK is waiting for really, is the fact that if prices rise but wages do not respond, that squeezes real incomes, it squeezes consumption, causes the economy to slow down naturally. So what they would argue is that the inflation that we're seeing is temporary, not permanent. But that depends partly on what happens to commodity prices. If they do come down later in the year, that's going to be fine. If they continuously rise, in those circumstances, much more difficult.
Is there any reason to think that they would come down significantly, given demand from emerging markets isn't going away? They're going to, China's going to continue wanting oil, and well, if anything, we're facing supply disruption risk from the Middle East.
Well, of course, we're seeing this supply-side shock coming through from the Middle East, which has led to significantly higher oil prices. That's made things much worse, of course. But ultimately, if the emerging nations themselves tighten policy, they themselves will be responsible for driving commodity prices lower. It's important to remember that part of the reason why commodity prices are rising so quickly is this strength of growth in the emerging world. If they can control that, then actually commodity prices may come back down again. So, funnily enough, the US, the UK, Europe need the emerging nations to control their credit growth and their demand, because only that way will you see commodity prices come back down again.
Is there a willingness in the emerging world, I guess particularly on the part of governments and politicians, to acknowledge or accept that curbing inflation will mean slower growth?
There's a mixture here, frankly. In China, I think there's a strong recognition of this. And in fact, if you think about the Chinese 5-year plan, it's only for 7% growth a year compared with 9-10% that we've had in the past. In Latin America, probably more questionable. Brazil has tried to bring inflation under control largely by allowing its exchange rate to appreciate, but that hasn't really worked very well. Brazilian inflation actually is still rising, so there's some difficulties there.
We've been following, obviously, BOJ actions, a yen trillion loan package to help with rebuilding. I suppose we can expect an ultra-loose monetary policy in that country for a while yet. How does that impact the country's fiscal position?
Well, the loose monetary policy will help the fiscal position because it will prevent bond yields from rising significantly. The other reason for a loose monetary policy is to try to prevent the yen from rising. Because one of the dangers when you've got lots of rebuilding and so on is that you need to divert resources into a domestic reconstruction. If you divert resources, they have to be diverted from somewhere. And one way you can do that is to have a stronger currency which basically squeezes exports. So I think the Bank of Japan is aware of that, wants to try and make doubly sure that the yen doesn't rise too far.
Okay, Stephen Green of HSBC, thank you so much for coming in. Stephen King of HSBC, great to have you in the studio. Thank you so much for your time.